Good afternoon and welcome to the webinar by Construction World, First Construction Council. We are here to deliberate on a very important issue. Of course, everybody's aware. I'm Pratap Padode, Editor-in-Chief, Construction World, Infrastructure Today magazine, and founder of First Construction Council. Just before I begin, I'm just sharing a video with you. And this is a series of webinars that we are organizing. This webinar is being organized by FIRST, that is Foundation of Infrastructure Research Studies Training. And I am going to show you the okay, so here we go. You can see it on the presentation on the screen. So Budget 2021 is the absolute exciting event that's taken place yesterday. And before we move further, here's a small short video.
देशवासियों के जीवन को कोरोना के प्रभाव से जल्दी बाहर निकालना आज हमारी प्राथमिकता है। इसमें अहम भूमिका रहेगी नेशनल इंफ्रास्ट्रक्चर पाइपलाइन प्रोजेक्ट की। इस पर 110 लाख करोड़ उससे भी ज्यादा खर्च किए जाएंगे।
Okay, back to the slides. Board of Governors. Let me introduce you to the Board of Governors. Some of them are already here with us on this panel. Our media partners are Swarajya Magazine. So Construction World, the magazine in the running for 24 years, is the largest circulated construction magazine, circulated to over 800 cities in India, now entering its 25th year. Equipment India is India's first and only construction equipment magazine. Some of our other magazines include Infrastructure Today, Industrial Product Finder, Indian Cement Review, Project Reporter. And of course, our website constructionworld.in is the top ranked website for those in construction, real estate, and infrastructure business. One way to stay connected with us is CWOW. So if you give a missed call on this number here, 8657581117, and save the number, you will continue to receive updates regularly from the construction industry. So I've never witnessed a union budget speech where so much time was devoted by the finance minister to do infrastructure. So let's jump right ahead and let me get you the panel. On the screen, Mr. D.K. Sen, Director, Larsen and Toubro, Mr. Deepto Roy, Partner, Shardul, Amarchand, Mangaldas, Mr. Hemal Mehta, Partner, Deloitte, Mr. Pradeep Singh, former Vice Chairman and MD, IDFC Projects, Mr. Sandeep Singh, Managing Director, Tata Hitachi, and Mr. Sumit Banerjee, former MD and CEO, ACC Limited. The topic today is Budget 21-22, and then, as you saw, we are coming up with a series of Infra Nirbhar webinars. Infra Nirbhar, not Atma Nirbhar. This is Infra Nirbhar webinars plus e-conferences on Make in Steel, revolutionizing ports, and our biannual cement event. The aim of this webinar, however, is to evaluate the impact of the Union Budget 21-22 on the construction and infrastructure sector. We will come back to this panel just right after this poll. So if you look at your screen, there is a poll and you need to select. In the first poll, you need to select maybe more than one. So people are worried about, and what are they worried about? Job creation, demand, GDP growth, public spending and investment, finances and loans. This is a multiple choice. Whatever you think, you can select and we can share the findings. So there are multiple options. You can select multiple options. If you think more than 2 items are the cause of worry, then you can click all 3, all 4, all 5, or 2, or just 1. So 60% have voted so far. So just 10-15 seconds more and I think we can have our answer. Okay, so job creation obviously is the highest cause of worry with 68%, followed equally by public spending and investment, finances and loans, a little bit here and there with demand and GDP growth. Here you are. Right after this, I have another poll. Has the budget met your expectations? And there are just 4 options and you can choose one. This is not multiple choice. Okay. So around 60% have voted already. Okay. All right. So yes, of course, yes, people say 42%, somewhat 28%, could do better 22%. So yeah, it's not a clear win in that sense, as everybody imagined. And one more poll, the last one before we start our discussions. So which sector has received the greatest attention after healthcare? Is it manufacturing? Is it infrastructure? Is it agriculture? Or is it the MSME sector? Yeah. So quite clearly, this seems to be a resounding, unanimous one. So let's close this. 76% are showing infrastructure has received major focus, and that's true. So if 2019 was a difficult year, imagine 2019 was a difficult year for the global economy with world output growth slowest pace of 2.9% since the global financial crisis of 2009, declining from a subdued 3.6% in 2018 and 17, and then 2020 broke all records. The contraction by 4.5% in 2020 is now looking at a revised outlook growth of 5% growth in 2021. Amidst a weak environment for global manufacturing, trade and demand, the Indian economy shrank by 7.7%, but is now projected to grow by 11.5% and more depending on whom you ask. The budget has set the tone for this growth by providing an enabling mood and dispensation, or has it? We are here to discuss this, and let me now ask Hemal Mehta from Deloitte to take over. He will just quickly run us through few slides on the major announcements which have been made during the budget. Hemal.
Thank you, Pratap. I think all the participants probably chose the right sector, which is infrastructure. Let me just quickly share the slides. Pratap, how do you close this polling?
I'll just check box, cross it out.
All right, we are done. So welcome friends, and thank you for giving me an opportunity to just share some thoughts with you. Very quickly on the budget. I think if you see the real estate sector, I'm going to consider the real estate sector to start with. I think it was pre-COVID, there was an expectation that the sector probably will grow from where we are today. This is 2020, with a USD $180 billion of investments coming into the sector. I think the size was going to become almost 3.5 times in 5 years. And from there, it was going to grow further 1.5 times in another 5 years' time. So we are talking about moving from $180 billion to $1,000 billion, $1 trillion. That was the expectation. This expectation probably got pushed by a couple of years because of 1 year, which is the pandemic year. But having said that, if you see the entire market, the way things were happening, what actually went well with the state ministry coming out with some kind of reduction of stamp duty and some stimulus which was announced by finance minister during the pandemic time, which is now brought into the budget, which is especially the dimming range, the range of 20%. I think what really increased was actually a sale of affordable housing projects. Well, in Mumbai and Pune, we basically talk about compact housing as compared to affordable housing. But what really actually took a lead was that kind of a residential project. Again, with a drop in stamp duty, there was a huge increase in demand in Mumbai and Pune, among other places. So there was a demand pan-India, but I think Mumbai and Pune saw significantly high demand. There was a little bit of working capital or breather, as I call it, or oxygen, which was available with the developers to actually move forward with their inventory and actually pump in the money for in the unfinished projects. We saw that there were large lease which are due for renewals, probably were returned back by many multinationals. Many companies actually had reduced their rental obligation to 30%, 35% of the overall size, just to make sure that now working from home has become the new reality. But if you see the analysis of the commercial space, apparently it looks like that with a lot of businesses moving from, say, China to India because of the entire pandemic issue, there will be a demand. There will be another demand of a commercial premises which is going to come up, and that's why if you see the REIT, that there are 2 REITs today. We have both are Blackstone backed, and the third one is in pipeline, which is Brookfield backed. So if these big boys are actually playing they're very aggressive in the market, and they probably are looking at upswing on the market, I'm sure that they probably are backed by a proper study. The entire project, the way the real estate was developing, actually got broken into a very different way of structuring. It was purely revenue-based sharing. It was not a top-line based. It was not a committed amount. It was purely revenue-based. We earn and we share. If we don't, then you probably can take the retail space back. Again, the retail market, the malls, all the retail space, whether it was revenue shared models, a lot of developer actually underwent a pressure on the rentals. Broadly, we realized that there was a 68% increase in the sale in last quarter of this year as compared to the balance 3 quarters of 2020. Moving to the next slide, what was expected in the budget and what has come up? Certainly, affordable housing has always remained the darling of the department of the CBDT and the finance minister. And affordable housing is probably classified as infrastructure as far as many infrastructure definitions are concerned. It is getting a specific benefit under the Income Tax Act, which was going to get expired on 31st March 2021, which has been extended by one more year. It is a tax holiday on 100% of the profit made from an affordable housing project if the approvals of the projects have been obtained before 31st March 2021. So now the 21 period has been pushed to 22. Similarly, the debt funding debt funding which was been happening in the real estate market was done at a project level by the FPIs, foreign portfolio investors, which now can be done through a REIT or an InvIT. This is a big move. We are still waiting for our fine prints to come up, but a REIT or InvIT getting a debt funding from the FPIs, the entire IRR, the entire calculations of a REIT and InvIT of returns will probably undergo a change. I'm just going back to the affordable housing. This year in the budget, they actually added one more category for 100% tax reduction for the developers who are engaged in affordable rental housing projects, which are of course notified by the central government. First time there has been thrust given on the rental housing. Now, certainly there is a tax benefit which is given to the profits, but the point to be remain to be understood and probably discussed. Again, I'm not critic to the budget, but generally sharing a thought that first of all, I think the government should have thought through that whether a rental housing project itself is a right business model to be in or not. Because I think the rental markets in India for residential units are not really taken off. And in addition, Finance Minister did speak in her speech that this is for migrant laborers. While the finance bill, the actual bill does not consider, has not kept this migrant laborer as one of the conditions, but it is an affordable rental housing project. We would like to see how it really shapes up. Otherwise, generally, we have noticed that there was something called as real estate mutual fund scheme, which came in the law about 10, 12 years back. It is theoretically doable, but practically, I don't think so anybody has really launched a mutual fund scheme for real estate. So like that, even this affordable rental housing project, to my mind, should not only remain theory, it should be practically implemented. Now, the other point is that certainly there is a lot of ease to actually access the debt market, debt finance for infrastructure and real estate sectors that opened up. We would like to see various guidelines or various fine prints which comes on the debt funding. But one clear indication the government has given this time in the budget, which is the first time we have heard in so many clear words, is that they are committed to put money in infrastructure and they are committed to raise money, not only by divestment proceeds, but also by raising debt, international debt. Another move was withholding tax on dividend paid to on REIT. This was again more of a clarificatory. So any dividend paid by SPV to a REIT or InvIT will not subject to a TDS. There was a cash trap. It was not a cost, but it was a cash trap, which has been now eased out. Safe harbor. Safe harbor is basically to overcome the dimming friction, which is a double-edged sword. That if we buy a real estate, any kind of real estate, immovable property, and if the actual transaction price is plus or minus 10% of the stamp duty circle rate, then there was a tax which was been levied on both recipient and the buyer and the seller. During the stimulus of packages which were offered during the pandemic, Finance Minister did came and say that any residential house which you are buying as a primary house, first house from the developer directly, which is less than 2 crore rupees to 20 million rupees of value, the safe harbor limits were extended to 20%. So up to 20% of the variance from the circle rate to the actual price, there was no additional tax which was payable by the seller or the purchaser. This actually brings a lot of impetus to the industry, and we saw a lot of sale happen pan India of affordable housing or a compact housing of which were a value which was less than 20 million. Moving to the next slide, what actually got missed out was taxing of unsold inventory. Now imagine in a year of pandemic when developer fraternity was struggling to sell their inventory. If we go back to some of the provisions which had came 2 years back to say that if any residential inventory is held by a developer for more than 1 year, there will be a deemed tax which will be paid by the developer under house property. Now, I think for at least 1 year, they should have probably given an exemption from this deemed taxation, especially in the current year where we are still trying to overcome the pandemic pressure. I think it was a very fair ask, which probably was not been considered. The other ask was a capital gain exemption for a REIT. And what is that we are talking about? So there is a very clear guidelines on the REIT which says that when the shares of SPV are exchanged for units of REIT, it's a tax neutral at the time of exchange. The developer or the sponsor of the REIT will pay tax only when they sell the units on the stock market. However, if a sponsor is sitting on a company which is owning multiple assets, and if they transfer the assets to the REIT in exchange of units of REIT at the time of sponsoring a REIT, the transfer, the swap of asset for the units is still not made tax exempt. This is the ask from the finance ministry for a long time. If they really want to see the number of REIT coming up the way number of InvITs are coming up, I think they have to consider this point, because there are many developers who are sitting on a master company, holding company, which actually has many projects into it. So this was something which was a reasonable ask. Maybe it has not been considered by the finance ministry this year again. Maybe I am hopeful that we should keep trying till the time they really hear us. Enhancing deduction limits. Now imagine that this year they have actually enhanced 2 lakh rupees of limits more for buying a house property. But the value of this house property should be less than 45 lakhs. Now, if you see, there are few tier 1 cities where you may not get anything which is at 45 lakh rupees. So we are not talking about tier 1 or tier 2 also. If we are talking about tier 3, tier 4, had this limit been increased by say up to 1 crore rupees or 1.5 crore for 1.5 year, like many other provisions they have incorporated, like that safe harbor range, 20%, which was increased up to 30th June 2021. Similarly, had they given this extension of limit for 1 more year, maybe tier 1, tier 2 population would have also got covered, and a larger population in this country would have taken the benefit of this particular deduction. Other was a safe harbor. Safe harbor, the 20% limit is only expanded for the residential project which are purchased as a first purchase from the developer and which is less than 2 crore rupees of value. 3 conditions attached. Rather than that, had they open up for all sectors, entire immovable property, real estate market for 1 year, irrespective of what is the asset class, maybe the entire market would have come up. Let me give an example of warehousing or logistic business, which generally doesn't happen in surface of Mumbai. It has to be outside of the municipal limits of Mumbai. So pan India, when you see a logistic or warehousing business coming up, the biggest challenge which we face is that the circle rate or stamp duty value sometimes is as high as 2 times the market value. Now imagine if my stamp duty circle rate is 100 rupees and my current market rate is 40 or 50 rupees. Which warehousing company or which logistic player are going to actually buy a land to convert it into a warehousing or logistic park? It becomes a non-starter because the project cost itself, including the deemed tax cost, it actually changes the entire commercial of the business. So I think this was an ask which probably was very loudly been informed to the government, but it got missed this time again. So this was broad. I just wanted to give some kind of an idea, broad idea to the audience that this was the ask. This was what are the hits, what are the misses on the real estate structure side of the business. Maybe I'll hand it over back to Pratap. Pratap, over to you.
Yeah, thanks, Hemal. I think thank you for covering the real estate sector, which did not find much. The finance minister did not devote many words on real estate, and but yet you've been able to point out some of the nuggets deep inside. So let me go over to the panel now, and let me ask Deepto Roy. What projects do you think are going to be likely to take off in 21-22? I mean, so much thrust on infrastructure. I think a lot of them have been provided in finance minister's annexures as well. But which projects are we really hopeful of in terms of creating that kind of acceleration?
So I think, Pratap, as you rightly said, I think this is one of, at least sort of in recent memory, the kind of emphasis that was put on infrastructure was quite significant. That's not to say that previous budgets have not identified infrastructure as something which is key. But what tended to happen was that, it was part of the sort of mix of things. But I think ever since, sort of we've been talking about the Atmanirbhar, program, And I think the government has realized that one of the key things that drives Atmanirbharta or self-sustainability is world-class infrastructure. And and I think the sort of for me the heartening part of this budget in terms of the allocations and as well as some of the thought process that has come through is that there's a lot of clarity, and there is sort of one of the things that we frequently discussed when we talked about core infrastructure before the budget was that we wanted to see the government put money where its mouth is, in the sense that actually identify projects and actually identify sectors where they're going to make significant capital allocations, and they have come out and done that. So whereas previous budgets sort of tended to talk in more hypotheticals in terms of, let's say, smart city development, which was a goal but which wasn't really sort of put in place in concrete terms. I think the good part about yesterday's budget was that there were clearly certain sectors which were identified and a roadmap which was laid down for each of those sectors. Now, I think the sort of the most emphasis went into transportation, in particular roads and railways, and I think that was where I think there was a significant budgetary allotment which was made. So for road development and highways, the finance minister actually announced a budgetary allocation of 118,000 lakh crores, which 108,000 was for capex, which is again sort of in recent memory, that's one of the largest allocations. Specific states were identified for significant development of national highways, which included Tamil Nadu, Kerala, West Bengal, and Assam. But in all, there was also sort of identification of projects as well. And I think one of the things that is, again, sort of we were expecting from the budget and which has come through is that this is a government that does very well when it goes into project development mode. So when it identifies certain specific deliverables, whether you look at it in terms of the, sort of the LPG subsidy delivery, or if you look at it in terms of Swachh Bharat, whenever it goes into project mode, it really sort of can deliver results in very short time. And I think one of the sort of sectors where we want and we think that will happen is roads. There is sort of a 8,500 kilometer pipeline that is being considered for national highways as part of the national infrastructure pipeline, and that's where, because the allocation is so significant, I think that can rejuvenate the road sector, which if people have been following it carefully over the last few years, has actually been quite moribund, because sort of new road developments, new BOT projects have seen few takers. NHAI sort of experimented with what they call the hybrid annuity model, but even that sort of was a little bit here and there. So I think this is something where the budgetary allocation will actually help. Railways, I think, again, has been sort of something that the government has been sort of quite following up quite majorly on. Last year, as part of the Atmanirbhar package, there was a significant emphasis which was made on PPP in railways. And as a result of that, I think following up with that, there is now the announcement of 3 dedicated freight corridors which have to be developed on a priority basis, as well as sort of the ones on your screen: Kharagpur Vijayawada, Bhusawal Kharagpur, and Itarsi Vijayawada. These are the 3 which will form effectively a triangle. And there is also emphasis on completion of electrification of all our broad gauge rail, as well as coming up with sort of the national rail plan by 2030, with what the government is terming the future ready railways. And I think all of that needs to be actually read with the PPP program, which, while it was not emphasized in the budget, but is actually a massive program which the railway ministry is already undertaking. Apart from sort of transportation, there was also a lot of emphasis which was placed on urban infrastructure, with again sort of the finance minister emphasizing that sort of there will be a lot of concentration in developing public infrastructure, public transportation, and urban transportation infrastructure. A sum of about 18,000 crores was allocated to developing PPP models for bus transport services in major cities, where they will now get private sector players to finance, acquire, and maintain buses. And in addition to that, there was a significant central counterpart funding which was set aside for metro rail projects in Kochi, Chennai, Bangalore, Nagpur, and Nashik, as well as there was a talk of this Metro Light and Metro Neo sort of transportation systems which will be incorporated in tier 2 cities, as well as sort of the suburban areas of some of the tier 1 cities. And that's sort of, again, well identified, specifically allocated funds for developing project-wise infrastructure development, which sort of gives the impression that it's not something which is in the air. It's something that they intend to do in a very short while, and it is something that is achievable within a short while as well. Again, fair amount of emphasis on power sector reform, particularly on the distribution side. This is a bit of an intractable problem because we have been talking about DISCOM reforms for a very long time. If you look at the amendments suggested to the Electricity Act, which the central government tabled last year, a lot of it was spent on DISCOM reform. The the sort of the liquidity scheme which was announced for DISCOMs again last year was also based on fundamental reforms at DISCOM level. That has been emphasized again in the government as in the budget, as well as a 300,000 crore budgetary allocation for DISCOM modernization over 5 years. I think the government has identified DISCOMs as sort of distribution as a piece of the electricity puzzle which needs urgent intervention, because it also tends to sort of then flow up and sort of improve generator health. Because one of the things that was quite prominently missing was a lot of information or a lot of incentives for the generation sector as such. There was allocations made to two of our renewable players, which is SECI and the IREDA, but not much else from a generation perspective. So I think on power and energy, the outlook is very much aimed at distribution reform. On sort of on the Ujjwala scheme was extended to 1 crore more beneficiaries, and there is now a talk of a independent gas transport system regulator, which will then allow open access to natural gas pipelines. So again, sort of the emphasis very clearly on the energy side has been on distribution reform and sort of modernizing our distribution infrastructure. So that is again something that we think that will actually get implemented in the next few years. The central government had announced sort of privatization of some of the distribution utilities in the union territories. That is not something that saw a lot of traction and is still sort of in the back burner. But I think distribution reforms is intended ultimately at some form of privatization. And sort of my last piece of what I want to talk about is that on top of just making these allocations and saying that capital expenditure will be made in the for certain activities, the government also announced a number of reform steps on the fundraising side. And I think you Pratap, you mentioned the sort of the emphasis on international fundraising, and the government has announced that there will be a new developed finance institution which will be set up with a 20,000 crore corpus. And we'll look at.
I'll take that question. In fact, I was just coming to finance because you have outlined all the spending aspects, all the projects which are going to be huge, require huge amount of resources, and that's why my immediate next question to Mr. Pradeep Singh is, where have we, by setting up this development financial institution or letting InvITs and REITs have more borrowing powers? Obviously, there is a low rate of interest in the world over. Is this enough? We've had a national infrastructure, NIIF fund as well, but is this enough to unleash the kind of resources that are needed for these ambitious projects? Mr. Pradeep Singh. You need to unmute, Mr. Pradeep Singh.
Thank you, Pratap. I think Deepto has set it up very nicely. Let me just start by saying that I do think that on the whole, this is a good budget. I liked its simplicity and focus, and as Deepto also mentioned, the clarity that you found in it. It does not try to do too many things and open too many fronts. It did not play to the gallery, yet tries to address the core challenges, despite the difficult environment created by the pandemic and the looming Chinese threat. I did not see any glaring inner inconsistencies in the budget. And as has already been emphasized, its focus is clearly on providing a stimulus to the economy through a 25% increase in the capital outlay by the government in infrastructure sector, is in particular, defense as well, which obviously has a large multiplier and downstream investments in income effect. Apart from the stimulus effect of the investment, infrastructure in any case will help address the famous painful gap in infrastructure that this country faces. So in that sense, I guess one can always wish for more and one can always find fault. But on the whole, a well-directed, strategically directed budget. And as Deepto again pointed out, not just talking in terms of concepts, but fairly concrete in terms of identifying the kind of interventions that are proposed. Now, the revenue mobilization strategy, which is what you just mentioned, I see in it both good news and bad news. Clearly, firstly, of course, there's an expectation of more than 14% increase in tax revenues on the back of a similar growth in the nominal GDP, which is the expectation, which hopefully will be realized. If it is belied, we have a problem. But the revenue mobilization strategy also relies very substantially on monetization of government assets, including infrastructure projects. So monetization of infrastructure projects in order to finance monetization. So it is recycling of government capital at its best. So whether it is in roads or in ports and other sectors, which have been clearly mentioned, monetization of infrastructure, brownfield infrastructure projects, as is being called, has been identified as a very core strategic intervention. Disinvestment, which is on the same continuum, disinvestment in public sector undertakings, including significant land holdings, which has been again identified very clearly as an intervention. In fact, a special purpose vehicle is proposed to be set up to be able to mastermind that transaction. Public sector banks disinvestment, LIC disinvestment. The good news in all this that I see is that monetization as a strategy is obviously reflecting a renewed and bold commitment by the government to private capital and private management, including foreign capital and foreign management. The budget makes that clear, and the FM's comments in subsequent interviews, including the one that you see in the Times of India this morning, were even more forthright, pretty blunt actually, pretty bold. That this commitment to the private sector is being shown despite public criticism, which has in fact picked up steam of late, against the government bias for capitalists and corporates, is a bold move, and I would commend the government for it. So that's the good news that I see in all this. In fact, there is a committee on asset demonetization that has been established under the cabinet secretary. In fact, it's been functioning last year. The Niti Aayog has been commissioned to coordinate the effort and so on. But let me take this opportunity that you've provided, Pratap, to also make a related point. The thrust on demonetization of brownfield infrastructure assets is essentially a new avatar of the good old PPP approach. So the government seems to be pragmatically accepting that the development and execution risks associated with infrastructure projects, and Mr. D.K. Sen, as a representative of one of the leading contractors and developers, will bear me out. The government appears to be, we have somebody needs to go on mute, I think. Yeah, thank you. So the government appears to be accepting the pragmatically the view that the development execution risks associated with infrastructure projects are just simply too high for the private sector. So the government appears to be veering towards taking the development and execution risk on itself, and then bringing in the private sector to so-called brownfield projects, which are projects developed by the government, executed by the government, to monetize those projects, to recycle the capital, but in the process bring private sector efficiencies and management for the operation and management and maintenance of those very projects, and to take some residual commercial risk of the future revenue generation and the management of costs of all those projects. So in that sense, it's a good news that government is being pragmatic, is accepting this reality. Over the last couple of decades, the country has tried bringing in the private sector for infrastructure development and infra projects, where the private sector was the developer and executor. We've seen BOT roads, we've seen IPPs, we've seen four large airports, some ports go into private hands, but the experience on the whole has been mixed and has caused substantial pain to the private sector and large NPAs with the public sector banks. The demise of ILNFS and IDFC in its original form. So on the one hand, the monetization of brownfield projects appears to be responding to this experience. But the bad news that I see is that in the process, the government seems to be no longer focusing on addressing the fundamental challenges that led to these failures of PPP in its full form, where the commercial projects are developed and financed by commercial capital. And in the process, there is a sensitivity that the private sector develops towards life cycle cost. It brings innovation, reduced life cycle cost, because construction and O&M are combined together. So all of those good things about the PPP strategy that we have grown up with, they seem to be getting lost. So and that's disturbing, because many, if not most, of those underlying problems, because of which that approach was a mixed experience and did not succeed as well as we would have liked it to, many of those underlying challenges are in the domain of public policy. The government needs to address those fundamental drivers of the execution risks, because of which those issues have come to a grief and have left NPAs with the banks and dud projects, half-completed projects on the ground, and private sector capital blocked, and so on and so forth. So I can't help wishing that the government should also bite the bullet and start addressing those challenges, rather than just throwing away the baby with the bathwater and focusing on brownfield monetization, which by itself is welcome. So I'm not saying that that's, but it's a bit of a cop-out. So that's the mix of good news and bad news that I say in this, which I wanted to point out. Otherwise, hopefully the disinvestment strategy and monetization will work, and hopefully the 14% nominal growth rate in GDP and accompanying heavy revenue mobilization will happen, in which case we'll be able to do all the great things, 5 lakh crores, 25% increase in capital expenditure, all of that. Otherwise, we'll have a problem.
We'll come back to that, Mr. Singh, in a bit.
Yeah.
Let me go over to Mr. Sen. I think order book positions of everybody seems to be in a delighted mode. I think all of them are expecting huge amount of orders to actually swell up their books. So where do you see, Mr. Sen, where do you see the major demand for projects coming from? Which sectors do you see as most promising from a contractor's perspective?
Well, to start with, I must say that directionally the budget was very good. It has moved in the right direction, and the kind of challenges that the government has taken on itself to generate money, generate fund without adding more tax, to generate fund by monetizing the assets. This is a tall task, and I can see even the DFCC corridor, what is just being completed is still not completed. It will be operational by end of next year. They have thought about monetizing that also. That means they are very aggressively, they understood what Mr. Pradeep Singh has told, that they didn't address the basic issue why the infrastructure projects get delayed. So they understood that it is difficult to bring the developers into making a brownfield project because of the huge challenges which they're not able to solve. So now what they're concentrating on, probably to do all these projects mostly on EPC mode, thereby taking the risk of delay on the client, and they are trying to monetize and get the money from developed projects where the construction risk is not there, it's operational. And whatever is the revenue that is there on the ground, nobody need to guess as to what will be the ridership and what will be the kind of revenue from the asset, because they are implemented, they are operational. You go and find out and put whatever money you feel the best and get the project on a TOT mode. So that probably is good, but whether even then also they'll be able to get the money from the market to get the monetization. But one good thing is that they're inviting foreign investments into InvIT, and there is a possibility now because everybody overseas is sitting with money to invest, and they only want a safe mode. And they have found out one thing: TOT and the InvITs are probably the safest mode because it's an operational asset. There is no risk as far as the construction or delay risk is there. Having said that, I continue to see the order book growing mainly from infrastructure in the areas of roads, in the airport, in the areas of railways and metros. When I say railways, I mean broad gauge lines, freight and passenger carrying, whereas metro is supposed to be mass rapid transit system. So I categorize them differently. In road, the government this year again targeting to bid out award 8,500 crores of kilometers of road this year. They could not, they had a tall target last year, if you remember. They had planned for 10,000 kilometers to be awarded, which they could not do. So they again had to retract, and now realistically they have put 8,500 kilometers, out of which roughly about 3,500 kilometers will be from a national highway in terms of expressways. Several corridors they're opening up. Bangalore, Chennai expressway corridor. These corridors are going to be the vehicles of growth, not only for logistics, but also the development of the surrounding areas in terms of, in terms of factories, other commercial and residential establishments. So they are creating these corridors of development. There are several corridors, over 8 or 9 corridors: Delhi, Dehradun, Kanpur, Lucknow, Chennai, Salem, Raipur, Visakhapatnam. So all these corridors are very long, about 500, 600 kilometers long corridors, and they connect two very major important cities. And if you connect two important places and then pass through various other places underdeveloped, generally it will come up by virtue of being close to these two big cities of commercial importance. In relay also, good that this dedicated freight corridor, both eastern and western, are at the verge of coming to an end, maybe another 1 year, 1.5 years. Partly it is getting already commissioned, partly one by one they will be commissioned. So government is going to look forward to going for further 3 more freight corridors, as I think Deepto has told already. These corridors are actually being targeted to be developed. Apart from this, they also have ambitious high-speed rail. They have just awarded 2 packages, and now there are a whole lot of packages because the whole outlay is about 100,000 crores, out of which only about 35,000 crores have been awarded. There will be a huge scope in that, and the way government is going, the high-speed rail authority is fully prepared. They have been working on this project for a long time. The DPR, the entire tender papers are all ready to be floated out, and it will be with JICA funded. So there will be no problem on the government side. At the same time, it will bring in a lot of impetus to Indian infrastructure. In metro also, I find that there are about 4 or 5 new city metros are coming up. Kochi Metro Phase 2, Chennai Metro Phase 2, Bangalore Metro Railway Project Phase 2A and 2B, Nagpur Metro Rail Project. So these are all are areas where substantial work will be done. About 5.5 lakh crore, if I have understood, is invested, out of which 1.5 lakh crore has come in roads, another 1.5 lakh crore approximately will come in railways. This is the capital expenditure. That means there will be further more cost incurred to it. The project value will be increasing. So these are all commitments made during the NIP. If you remember, 5.5 lakh crore investment is actually 30%, 40%. If you make it to 100%, that means 20 lakh crore, what the government had told that they are going to invest every year to make it a $5 trillion economy. This is being maintained. That's a very good sign, because having had a COVID year and still getting back into the same vehicle and moving in the same speed is very good. And government has been very realistic. Instead of putting up a false fiscal deficit, they really disclose the actual situation. They have decided to borrow money to fund the fiscal deficit instead of putting taxes on the people. That's very good. They are having ambitious plan, the monetization, banks, LIC, I mean some insurance companies. Tall task, a lot of objections will be there. But the way yesterday the Honorable Finance Minister presented the budget and then subsequently attended several long interviews by changing her dress 2-3 times, I think they are very confident and we are really in safe hands. Thank you.
Thank you, Mr. Sen. I think you have outlined all the attractive areas for swelling up the order books, and indeed, I think for once the finance minister's speech seemed to be seamless in terms of our thought and what was being indicated and what was being said, and it seems more plausible, credible, of course, because they have admitted to figures which one would have been otherwise shy of admitting. And yeah, there is an opportunity here. We are very clear that we can borrow. There are low rates of interest. I think all the projects you mentioned, especially metro rail and high speed rail, they've got funding from agencies which are offering long-term 50-year funding with hardly 0.5% rates of interest, which is a kind of an FDI in a way for us. So great. Affordable housing, as Hemal earlier mentioned, seem to be one driver for a lot of building materials. And of course, there have been steel prices have been on the rise, and so have been cement. And our minister, Mr. Nitin Gadkari, has been quite upset with that. So the budget has brought in some duties as well. So I want to go to Mr. Sumit Banerjee. Mr. Sumit Banerjee, what do you think? Is this a signal for cement and steel, particularly cement, to start expanding capacities with so much of NIP, National Infrastructure Pipeline, as Mr. Sen also pointed out, underway? Money is being raised in that fashion, maybe asset monetization program and all that. Is it time?
Hi, Pratap. Hello, everyone. Am I audible?
Yes.
Okay. Thanks for that question. I'll try to do some justice to that. The first thing that I'd like to mention is that at least cement, if not steel also, have never worried about budget to set up their capacities. Steel and cement has been quite contrarian in their decisions to set up capacities, in my experience. A bit of pre-budget situation will make a context here that when the financial year started with the COVID pandemic and all that, people were really spelling doom for steel and cement industry. And if I remember correctly, cement industry was forecast to even have a decline of 30% in this financial year, in the first couple of months of the financial year. From there on to today, we have cumulatively we have had a drop of only about 11%, growth, decline of 11% in cement industry. So I would say that's a huge makeup from initial estimate to today. Steel industry is doing even better because steel industry also has the possibility of exports, and which cement doesn't have. And steel industry is doing well on exports, I'm told. But all in all, with all these, also the capacity utilization of both these sectors uh, are somewhere around 70 odd percent. And therefore, logically speaking, investments uh, are not called for at this stage. But as we know, investments in steel and cement sector take a long time to fructify. These are very high gestation periods. And therefore, sometimes steel and cement players tend to invest in the troughs to be able to be in line with the demand growth when the crest comes up. So, that's what I mean by saying contrarian, investment decisions. And you might have noticed that already, even before the budget. Uh, Companies like JSW Cement and Ramco Cement and Dalmia Cement, and I guess even Ultratech Cement, they have announced creation of new capacity, investments in new capacity during the pandemic, before the budget. So what more can we, what more can we as analysts or as share market observers, what more can we wish? Even in this situation, people are ready to invest into new capacities, kudos to them. So that probably answers part of the question, but coming to what the budget will do to spur demand, yes, infrastructure, I'm sure that we have discussed it all. And real estate, not so much, but infrastructure, surely a lot of demand will be generated, both for steel and cement. And we have to keep in mind that the demand for cement, particularly, is largely from retail consumers in India than from infrastructure. Of course, this has to change and infrastructure has to pick up, but we are a long way from there. So as on date, for example, India's cement basket demand 70%, 65% is retail, and rest is part real estate, part infrastructure. So the point I'm trying to make is that even if there is a lot of infrastructure activity and there is an incremental growth in infrastructure project activities in the coming years arising from the budget, it will have a lesser impact on cement consumption than if rural consumption was to pick up, retail consumption was to pick up, people would start making discretionary investments. People will have money in hand and would start making discretionary investments in repairs of own houses, conversion of kacha houses into pakka houses, making small bungalows or villas or homes in small towns and grade 2 or 3 or 4 cities and villages. So that's the real cement demand as things stand today. And the budget probably has not done much directly for that. As we know, this budget has not been a demand creation budget, but this budget has been more like a Keynesian budget where, we are not digging up roads and making new roads, but we are making new roads. So, so we want to create jobs by infrastructure projects, and that's what the government can do, and they're trying to do that. But coming to cement and steel demand, I think we have a yes and no kind of answer.
So luckily, I think the agri demand already was on a better wicket given the better monsoons and I think a whole lot of direct benefit transfers that the government did during this pandemic. So
Right.
probably affordable housing in tier 3 may have a better impact with the budget proposal of what that extension that the government has given for 1 more year. And that, like you said, it translates into individual homes that people probably would take advantage of. Coming to construction equipment, I want now, construction equipment was given some time to comply with the emission norms, and they come into effect from 1st April 21. And Mr. Sandeep Singh, is construction equipment sector ready, and how does it react to the blueprint of infra growth in terms of what lies ahead?
So thank you very much, Pratap. Thanks for being here amongst all of you. As all the panelists have already, given very good perspective of budget. That is, it's a demand-oriented budget, and government has really is going to give huge amount of focus on infrastructure development, accelerating the infrastructure demand, and enabling funding of project. That is the most important thing which we have been facing, where there has been a allocation of project, but then how do we fund those projects? I believe, as the panelist mentioned, the government has, I think, put right blocks in place, and we expect that there will be a good demand. And what we are looking at is that one, that is the demand is driven by the road sector, and that's going to put pressure on the manufacturers to, number one, build up capacity, bring in technology, advanced technology, improving the efficiency, meeting the requirement of a customer, which sometimes brings a challenge. The other thing what we are looking at is the controlling the cost of our manufacturing, because that is becoming another challenge while meeting the requirement. Today, what we see is, on one hand, we look at the demand creation. On the other hand, we see the steel prices going up, input prices going up, which brings a lot of challenge. But overall, I believe the budget is very good. It's going to bring in huge amount of energy for construction equipment sector. We need to work very closely with the government and other stakeholders to ensure that we are able to put all the resources in place to develop infrastructure, bring in customized solution, bringing more attachments, meeting customer requirement in terms of efficiency, cost. So these are some of the things which we believe is going to play a very important role. Capacity utilization has not been very good. We have seen good traction in the last 3-4 months. We have come to 70-80% of our capacity utilization. We believe by the end of this year, we will be somewhere around 80-90%. So availability of machine construction equipment may not be an issue. Controlling cost is going to be the biggest challenge. So overall, I think it's a big plus what we have seen. We believe that these announcements are not for, as you see, the allocation of fund is not only for a year or two. This is going to help us to drive the demand for a long-term period. So therefore, we can now plan ahead to for a capex. That which is again a very important part in our business, because if we plan capex today, it will give us results in next 2 to 3 years time. So therefore, we are all working towards that, and I'm sure it will bring in good amount of energy and positive energy in the market.
Thank you, Mr. Singh. So the other issue is, private capital is still being shy so far. I mean, it's not only about the pandemic. Even before the pandemic, private capital was shy. Public spending is what's supposed to kick, like Keynesian, Mr. Banerjee mentioned, way of working is public spending needs to be high, and therefore, and the stage needs to be set, and it needs to be conducive. Risks need to be mitigated, like Mr. Pradeep Singh said. But yet, do you think with all these things which have been taken care of now, with the intention declared in the budget and asset monetization and various other InvITs, REITs processes mooted, do you think the stage is set for private capital to make a comeback, Mr. Pradeep Singh?
Yeah.
Oh, sorry. I'll just take it to Mr. Pradeep Singh.
No, I think it certainly, there are lots of incentives, positive signals that this budget has for the private sector. And not only in terms of the things that we've been talking about, but even the government's willingness and openness to keep tweaking the InvIT structure, they keep modifying the REIT structure in order to make it more and more attractive. The infrastructure development funds can now issue tax-free instruments. The kind of provisions that InvITs are trying to create for being able to draw the international investor. All of those are certainly going to be positive, and the monetization exercise, it may fall short of those of us who are great greedy supporters of public-private partnership. But still, I think realistically, that is where we are going to be able to prime the pump as far as the private sector capital is concerned. By the way, on this issue of InvITs being used as one of the promising instruments, I do wonder, and it will be interesting to hear other panelists' views on this as well. While the InvITs, I think, is a great structure for attracting private sector capital, I don't know whether the government should be resorting to InvITs for its own projects, such as PGCIL and NHAI, as they are doing currently. Private sector is in the business of operating, managing projects. So retaining a 15% or a 20%, 25% share in the InvIT and keeping O&M under their own control while floating an InvIT and attracting other capital makes sense for the private sector. But why should government, when the finance minister has been very eloquent in saying, why should government be in businesses that they can't? I mean, we're talking about disinvesting out of all public sector enterprises except 4 strategic sectors. And even in there, they are saying minimal presence. That's a very, very sweeping reform if it were to come through, which I hope it will. If that is the case, then why InvITs for government projects? Why not the TOT kind of a structure where you lock, stock and barrel? Why do you want to retain 15, 20%? Why do you want PGCIL still to be operating and maintaining those assets or NHAI to be doing that? Why not give them to the private sector? Private sector can also then get ambitious and muscular and give you full realization for the project that you're giving to them. TOT, I think, is a brilliant concept, and it doesn't have to apply only to the road sector. So there is another hook here that's available for enhancing private sector capital coming in that government might want to look at.
Yeah, so
I don't know if
divestment.
other panelists have any view on this as well. Would be interesting to hear.
No,
I think
I actually agree with
yeah.
Mr. Singh a lot in terms of particularly his views on the InvIT. Because, if you look at the PGCIL and the NHAI InvITs, I think that, let's just take NHAI for the moment. I think the challenge would be when they are sort of marketing that is on who is going to do the O&M.
Exactly.
Because if your O&M is anyway going to be privatized, then what
they'll
is
get discounted. They will
exactly
get discounted.
so exactly, absolutely. So I think in that sense, I think one thing that they can achieve through the InvIT structure is actually to take in a sense, the InvITization risk on the government. So you set it up as a structure and then you get private and then basically exit it within a period of time. So the sponsor risk and all of that, sort of. So that may be the better way to do it. That NHAI takes the sponsor risk for that 1-2 year period, and then once sort of private capital comes in, they exit, and you have a professional O&M to run in it any event.
Currently, InvITs require sponsors to take a minimum, I think, 15% stake.
15%,
so that would have to be
and
amended.
Yes,
that would
and
have
for
to be
2
amended.
years.
Yeah, Mr. Sen.
And you also need to,
Let Mr. Sen also add.
In InvIT, the company which is actually putting the InvIT, they have to have 15%. They have to keep on operating the asset. So all the operational risks and everything will be, and cost will be on the company, and InvIT partners will be only taking the units. Okay, and the company will be there till the end, operating in 15%.
Also,
capacity.
Mr.
They have
Sen,
to
I
take
think
the O&M responsibility.
Also, the InvIT can borrow, and that borrowing will remain off the books for the government because it will remain with the InvIT. So in a way, they are transferring their borrowings into the InvIT.
Yes. And this time, previously, if foreign investments are not allowed in InvITs, now they have allowed it. So this is going to be a major boost because there are people, I see pension funds of various countries coming and flocking around to pick up assets. They want such assets which are operational in nature. They don't want to go to a greenfield or a brownfield under construction projects. So that is why government is so bullish. They know money is somewhere there. They will be able to get people to invest money and generate funds.
And an important change.
Go ahead, Deepto.
Sorry, and an important change which didn't get a lot of attention, but which the finance minister referred to, was this pension fund, sovereign wealth fund exemption that they introduced in the last budget. See, they made it very complex. So, you had to have 2, 3 other conditions that you needed to meet to get that exemption from tax and get a tax-free return. What she promised yesterday was to make it far more smoother. So it's clearly that the sort of, the sovereign wealth funds and the pension funds are clearly in the horizon. And InvIT is one of the major instruments where they are looking to continue to invest.
And Deepto, I think this DFI and the asset restructuring companies also will play a major role, because the banks are very shy to give you money. It is difficult unless you have a AAA plus kind of a credential. Banks are not going to do any financial closures. This will take the heat out of them. We have to see very carefully how it is being done. But if what we are thinking it will do, if it really happens, it will be a great thing.
So if I may add, Pratap, so it seems that in terms of being able to attract passive financial capital through InvITs and other routes, pension funds, insurance funds, I think we are doing well. In terms of being able to attract low risk private capital, which wants to take operating, maintenance, management risk, and through the monetization route, we are doing very well. But for attracting aggressive, risk-taking, entrepreneurial private capital, which also is very, very important, I don't think we've done anything in this budget.
So what about PLI? I want to go to Hemal and let me see. I think the PLI scheme.
Before I go to PLI, just one last point on this InvIT, on the stress asset. I think this model actually was successfully implemented in some of the European countries, right? Like Spain, Greece, so much a smaller size as compared to what we are. And this discussion of pulling all the stress asset into one basket and actually getting into a ARC and have professional management, get private funds, or some of these large sovereign funds who are happy to take a call on India for 10, 15 years. They were actually looking for a long time. And banks also clears up their balance sheet so that, everything actually goes on a streamlining. I think the only requirement was to take a hit on GDP, which finally, I think we took a call on that. Otherwise, till now, I think this is nothing new. I think this was discussed, debated time and again with various ministries at various representation. But I think at that time, I think finance ministry didn't want to take a hit on GDP. I think this time, one thing which majorly has been done is that one time you take a hit and just get funding done. I think that's a very bold move.
Yeah.
Sorry, Pratap, you were asking something.
Yeah. So I was saying that PLI scheme, now FDI is another source of rejuvenating the manufacturing sector. While we are talking infrastructure, obviously, again, the other source of FDI is the PLI scheme, which has shown great promise. So is it set for success? Beyond the first electronics and mobile that we introduced, I think there have been 10, 12 other sectors identified.
13 core sectors.
13, yeah.
13 core sectors, yeah. So to my mind, I think certainly PLI is probably giving a lot of initiative to new manufacturing unit, but this applies to new manufacturing units, right? I think today what is happening is that it probably is going to give boost to a lot of new manufacturing units in these 13 core sectors. But we also require to see that there are so many sectors which has got existing manufacturing units, which probably slowed down big time for various reasons in last about 10, 12 months time. Various reasons, maybe working capital. I think working capital was the main cycle because that's the biggest issue MSME always struggles with, right? The order book and many other things, right? So, Pratap, the point really is that PLI certainly offers a lot of incentive for new units, but what happens to the existing one?
So, Hemal, my experience, like we are also looking at expansion. We are also looking at giving some assistance to our vendors. But what we feel that each state has come out with their new industrial policy. And they are offering incentives like you see in Karnataka or maybe in Madhya Pradesh or in Rajasthan. They are offering incentive to MSMEs on their capital, on their investment. And what are your comments on this? Because that is also going to help them. Yeah.
Go ahead, Hemal. You want to answer?
No, I think you are completely on the point. And sir, I'll put one more point. Question to your point is the definition of manufacturing also is different. So today that is another added issue. No, I completely agree that state really requires to have a seamless kind of an approach, which I think we have seen in most of the cases. States don't have seamless kind of approach.
We
That
have
is,
seen a lot of changes. If you look at Tamil Nadu has been able to attract many investment. Karnataka is able to, put their act together. Whether it is, we have seen, especially in the last 2 or 3 months, huge amount of traction in government approaching industrialists. If you put in their application, they are following it up very aggressively, making sure that they iron out all the issues with the company. So I hope some of the states are going to do very well in this.
So,
I
Mr.
think
Singh,
first, sorry.
I just want to follow this up with, you've got another shot in the arm with the vehicle scrappage policy. How do you see that panning out for?
I think it is scrappage policy is a very long pending issue which was going on for quite some time, and I believe it's going to help the industry quite a lot, especially the commercial vehicles, because passenger vehicle 20 years is not a big thing, because normally people tend to change their passenger vehicles after 10-15 years. So we don't know how much that will help in passenger vehicles. But certainly commercial vehicles should help, and more so with when they are talking about PSUs and government scrapping their old vehicles, that will certainly help. But then they have to do a lot of preparation work, which I think government has done in the last 2-3 years, because we as a construction equipment manufacturer are going to play a very important role with some of these agencies for customizing machine for handling the scrap. So we have seen in the last 1 year huge amount of traction. Some new companies have been formed. We believe it is going to bring in good energy in the market. So it's a good announcement, but let's see how do they implement and execute it. That is going to play a very important role. It was badly required for the industry.
I think we want to now look at some pitfalls and some opportunities, and let's go around the table with all the panelists.
One of the question, Pratap, sorry to interrupt. Now, when we were talking about funding, government has also talked about asset reconstruction and asset management company. And that plays very important role for some of our customers, as well as people who are taking contracts for roads or mining or other parts. So would anybody like to comment on this, how these are going to play a role in this?
So you're saying asset reconstruction?
Yeah, asset reconstruction and asset management company, where government is also talking about infusing 20,000 crores in public sector banks. So how it is going to help the industries, especially infrastructure.
Mr. Singh, do you want to take that?
I can tell you what I've understood. There are a lot of stressed assets, and these assets become stressed because of delay in the projects, not entirely by the fault of the contractor.
Yeah.
There are actually projects where I know of a project in Karnataka where the project had to be terminated because the land and the forest clearances could not be achieved. They could not acquire adequate width of the corridor that was required to cut the hill to bring it to a proper stable slope, and also the forest clearances. So whenever you go there to do something, the entire community will stand there as if they are going to protect the whole community or environment. Now these are terminated. Ultimately, such things, if the client is good, they will give you a proper compensation as per the rule of the game. There are stipulations about termination. They give 10% more if the project is terminated not by the fault. So all these things are able to sort it out. Supposing there are developers whose issue is like this, such kind of assets to be restructured. That means there will be a agency which will take such sick assets. They will try to work it out to make it workable financially. And obviously the funding for this will be given by the government, and they are going to make it workable and then sell it. Okay, so this whole onus will be, as I have understood, these companies will do that work. They will take a asset, they will make it good. It will need some funding. Government will give the funding on a soft loan, and then once they make it good, they're going to sell it. to somebody who will be having an operating asset. Okay, I think that's the way it will go.
Yeah, but then it has to put in practice. The government has not been able to do that, or financial institutions were not able to do it in the last few years, especially post ILFS.
So, in case
So I think the challenge is that, for banks is that because of their prudential norms, they had very little leeway to do something like this. What this, ARC it's effectively what in Europe is called a bad bank, right? I mean, they are the ones who take over the NPAs and then turn it around. The other important fact is that we have always considered that the IBC, the bankruptcy code, was not essentially the right way to deal with projects of the nature Mr. Sen was referring to, where because of various circumstances they're not able to pay their loan, not because the promoter doesn't want to develop the project or wants to run away with the funds. There can be genuine reasons where infra projects get stuck, and without something like this in the IBC system, you just didn't have the resolution process. So I think that is another very important part. If it actually can raise the capital and can generate sort of significant expertise within itself, it can then help infrastructure bypass IBC in that sense.
Yeah.
but
what
I
they're
think,
talking about, can I?
yes, Mr. Singh.
Is that the banks have got a lot of NPAs in their books, and frankly speaking, like the government wants, bank also wants to clean up their book. Okay, and to clean up, there has to be a lot of help required from government side, from finance ministry side. This is a good intent. Once you clean up, like say in private company, we talk about providing. That suppose I have a bad loss somewhere, I take a hit and I clean up my desk and say, "Bhai, I have taken this year from my profit. I have taken a hit of this. My order book is clean." Likewise, bank also must have an opportunity. If you ask them to do it right now, and the whole thing, they will probably never be able to survive again. So it's huge.
So, yeah, so I'd like to say here that obviously this is an operation cleanup, like Mr. Sen is mentioning. But where we are missing the point is why does the situation reach this point? The fact that we have so much of risk embedded with the projects is like just simple mathematics. Mr. Singh, I'll come to you. But imagine if you have a 12% interest is what is the average last 20 years we've been saddled with. If your project delays by 6 years, your debt has doubled. So which business is going to be able to help that enterprise survive? And everybody is going to land up in the books of the bad bank only. So unless we correct this situation, right now we are poised with low rate of interest in a very good position to promote enterprises and entrepreneurship, and provided we can mitigate these risks. Yes, Mr. Singh.
Yeah, no, I just wanted to echo what you are saying, that the response to bad aeroplane designs is not to create great parachutes. So, one needs to address the fundamental issues as well. The ARC will, as a financial intervention, it's very good. It cleans up the balance sheet, takes out the toxic assets, makes it easy for the market and everybody else to deal with this. It's like side pocketing that we have been very familiar with of late. But to actually, for the ARC to get into the weeds and to solve the underlying problem, so not only have the financial muscle, but also the development and execution muscle to be able to solve those underlying problems.
Underlying problem is like faster payment, execution of no delay.
No, also the land and environment and forest, for example, that Mr. Sen mentioned.
I want
and there are a number of policy interventions that need to be made, and in fact, if those had been taken care of, then the asset would not have become an NPA in the first place.
See,
so there's no point kicking the can from one company to the other, unless, and in this context, if I may also link this up with this celebration around the DFI that we are all having. It's sort of it's deja vu for old timers like us. IDFC was set up by Mr. Chidambaram with much fanfare. Very similarly, even before that, IDFC was the single largest investment, equity capital investment of the government of India ever. And the investment came from the Reserve Bank of India itself. It was a very ironical thing that RBI had become an investor in an institution which was later corrected. ILFS itself was also promoted, among others, by the government of India, Ministry of Finance. In fact, The Additional Secretary, Ministry of Finance, sat on the board for years and years and years. And even in the end, when ILFS died, LIC was 40% shareholder of Island FS.
Mr. Singh, I want to interrupt here. Because time is running short, I want to jump to Mr.
So what I'm saying is
Banerjee.
that DFI alone will not be a solution.
Right.
We have already seen many come and go. IIFCL is still around unless we address the basic issues.
Mr. Banerjee, I want you to comment on the enforcement of contracts. I think there is one more area. We are ranking 163rd in enforcement of contracts in ease of doing business, although our rank in ease of doing business is 63rd. So, that's another area which takes everything to arbitration, dispute resolution, and mountains of disputes lead to bankrupt companies.
Yeah, you are right. It's a very crucial parameter or a factor in assessment of ease of doing business. And as part of Bombay Chamber, we have been, and I'm sure many other chambers, we have been trying to work on how this element, the enforcement of contract, can be improved. India's performance in this can be improved. And much of what has been said just before by Mr. Sen and Mr. Singh around the root cause of the bank NPS also are somehow linked with this, because even in public-private partnerships, yes, there has been mismatch between risks and reward. There has been badly designed frameworks for public-private partnerships. We have not learned from what has worked well in the Western world. Even today, we are trying to do, we did try to take ham-handed approaches of doing ham, a pun is intended here. But, we did not want to really work on models which would work. So at the end of the day, the thing that I want to say is that whatever way we want to strengthen our contract in a public-private partnership, there will be disputes. No contract is so foolproof. Even if it runs into 1,000 pages, it will not be free of possibilities of dispute, because some things may go wrong. So here comes the question of enforcing contract and resolution of disputes. Enforcing contract is nothing but resolution of disputes in one way or the other. And it is not that India doesn't have a strong legal framework in place. The rule of law exists in India. The problem is that the execution of the rule of law, delivery of justice, is so much delayed that it is almost denied. So when foreign entities, we talk about credit rating, we talk about FPIs, the foreign entities look at India as a market for investment. They do look at contract enforcement and dispute resolution speed. They don't suspect Indian laws. They suspect our speed of resolution of disputes. If you remember, the examples of Vodafone, you remember the example of Cairn, you remember the example of Daiichi, the arbitration in Singapore, Ranbaxy case, etc., etc. If you remember the case of Docomo, Tata Docomo and Docomo, RBI, this, that. So, and these are just a few. There have been many, many more. These are the big ones, but there are many medium and small size ones. So these examples abound where our legal system, the speed of our legal system has been unable to deal with resolution of disputes and give the confidence to the foreign entities that the contracts can be enforced here. So the way out from this, again, the example of para dropping out of an aeroplane, which is defective, that really was a very telling example. Here also, the solution of contract enforcement in India is not throwing more courts and more judges. You can talk about vacancies of judges, you can talk about less number of courts. The solution actually lies in completely stopping or reducing the inflow of disputes coming into the court. So the government has taken, again, here a few positive steps like Commercial Courts Amendment Act in 2019, etc., etc. And they have made mediation also. Mediation is very peaceful way of resolving disputes. They have made mediation mandatory, but there remains a few flaws in that law which doesn't really make it mandatory, and people are bypassing it by taking injunctions, etc. which we are working, we are trying to impress on the Ministry of Law and Justice if that can be plugged, in which case each and every commercial dispute will have to go through mediation, not arbitration, mind you, because arbitration that doesn't solve anything in my mind. Being from the industry and from the business, I have seen how arbitration can also be long-winded and ultimately land up through the whole court route into the Supreme Court. So it actually adds 2-3 more years to the resolution process, to the already average resolution timeline of 10 years in India. So it makes it 12-13 years. So mediation is the one which in Western countries have become very fashionable. And so in India also, you have to make it fashionable.
Running out of time. Just now, last one wish from everybody that would have been covered in the budget, which got missed, or your suggestion. Just one quick one. Let's not take, so can we go around? Let's start with Mr. Pradeep Singh. Mr. Pradeep Singh?
I'll defer this to Mr. Sen. I'll come back to this.
Okay, Mr. Sen.
I sincerely wish that much needed thing to be addressed. There must be a single window clearance to any linear infrastructure. There are about 23 or 27 numbers of clearances required to start construction, including mining, including factory licenses, including environmental, forest, tree cutting, utility shifting. All must be in one window, number one. Number two is that there must be state support to every project what center moots. Okay. Otherwise, center brings in a project, gives to the state. State doesn't honor because state is of a different party or governance and they don't support it. Number two and number three is that the government must pull up the government authority. That means the amlas, the secretary level and the chief engineers to solve the disputes. They sit on disputes for years and years. Extension of time dispute, they don't solve more than 1 year, 1.5 years, at least going down here. Come on. So
if I may just echo Mr. Sen here, single window clearances, of course, sounds attractive, but in the end, if the single window itself is very cloudy, it won't help. There was an SPV structure that had been followed for supercritical power plants, where the approvals were first taken, put into the SPV, and then the project was bid out. Okay. So that now, kind of
now people have become very careful. Even an EPC contractor, he makes sure that 80% land is available. Otherwise, he will not even touch the job with a bird's.
But to my mind, even 80 is not good enough. Why not 100%? I mean, why should even for 20% contractors get held to ransom?
We expect that you start the work in a 30-month project. By the time we are reaching one year, rest will get clear. There is a stipulation. If it is not there, you descope that space, that length from our side. But there has to be stricture on this. People, the contractor and developer are taken for a ride by this, by the authorities. Now they can't fool anymore. We had enough of the problems. Yeah.
Okay, Mr. Sandeep Singh.
Yeah, so I think I will echo their comments. Timely execution and implementation of projects is very, very important. And then faster payments by NHAI. And also, how do we manage the bad loans which have already taken place? We need to avoid them, but how do we manage that? Because that is also causing a lot of pain in the system. But I think overall, we have already talked about it. The better monitoring of projects, faster implementation is something which we would be looking for. Yeah.
Hemal?
I think they're talking about ease of doing business in India for a while now. We really require to stand. We really require to demonstrate that there is really an ease of doing business in India.
Yeah, yeah.
Deepto?
Mine is very specific to the power sector. What I was hoping for was some form of an integrated development plan for generation capacity in India. I think one of the major challenges that we are seeing as power sector, particularly with sort of the kind of renewable bidding that we have been seeing, is that letter allotments are issued, bidding is completed, and then discoms sit on those PPAs for years. And right now, if you see the amount of stranded capacity where people have already started investing, but for which PPAs are not executed, is actually quite staggering. And the only way to resolve this is by having a plan to implement generation capacity and not leave it to the states. That I think is a major miss.
Mr. Banerjee?
Yeah, if I may add a bit of diversity in the views here, and not just because of diversity, but because I feel it was the right thing to do at this stage, like many other countries have done. If there ever was a time when there was a need to give money to the informal sector and to the people who are jobless and who are not able to get two meals today, this was the time. And this money, I mean, it's very easy to say push more money into Manrega or something like that. I'm saying that Manrega is just one model. We can invent other models. We can be innovative. We can be mind-blowing. This government can be mind-blowing in terms of, thinking big and thinking new. But if there ever was a time to give money in the hands of the people in the villages and all that, this was the time, which would have in turn done a lot of things, done much more to spur demand and consumption at the grassroots level, and would have directly helped these people, but would have indirectly helped the industry as well. That has not been done.
Yeah, so I think that calls for another different webinar on fiscal versus monetary support during the pandemic. Mr. Pradeep Singh, okay, you're good. So I think that brings us to the end of our webinar. Wonderful. Thank you very much, panelists. I think you've been very, very articulate in lots of various aspects, and I'm sure our audience has enjoyed it. Thank you very much. And we hope to see you soon. And thank you all to the audience, and please stay safe. The virus hasn't gone away. Thank you.
Thank you.
Thank you.
Very much. Thanks to everyone. Bye-bye.
Thank you.
Thanks to everyone. Bye.
Thank you.